So if you've been wanting to buy a house and you've been watching, homes to see what goes for sale, you see the house prices keep going up and up and up and up. But the one thing that's really hurting you as well is mortgage rates. Did you realize mortgage rates about a year ago were 3, and then they topped out about 7.375 in November? Look where we are right now. We're almost 1.5% lower than where we were. So what in the world is going on? Because you start seeing, well, inflation still is a little bit out of control and all this other stuff that you hear in the mainstream media. But let's really dissect some of the information that came in this week, especially today, because today was a huge day. What we're seeing right now on the economic calendar is this. So we focus in on the inflation numbers because that's what the Federal Reserve is focused in on right now. They're saying as long as inflation's high, we're going to keep jacking up rates on everything to have people stop spending as much as they are. Okay, so what we're seeing right now is the consumer price index, the CPI, which basically is the consumer us, the inflation at our level, our the purchasers, people's. Okay, so let's get to the breakdown of what the numbers represented today. So the first line, what you're going to see is core CPI. So what the core means is they stripped out food and energy. I don't know about you guys, but gas prices here are fluctuating about 50 cents to a dollar on a daily basis. It's crazy. So that's one of the reasons why they strip out food and energy, because it's too volatile. They want to just kind of get, where everything else is. So the next line you're going to see is CPI year over year. Okay, the number that we had previously in November came in at 7.1. The estimates for December were 6.5, and it came in right at 6.5. I expected that number maybe a little bit lower, and I'm going to explain to you why, because I think this number still should be lower, but it's going to catch up to us eventually. So I hope the Federal Reserve doesn't keep raising rates to kind of ease the inflation numbers, because I'm going to show you where they're off a little bit. And on the one big component is housing or shelter, and they're completely missing the boat there, and I'm going to show you that. The next thing is you're going to see CPI month over month. The previous reading was 0.1. Expectations were for 0. It actually went down 0.1. So that's fantastic news. So the Federal Reserve, I know we're not back to 2% where they want things to be, but we're going in a nice direction. And then the other part of this equation is the Federal Reserve has it out. They want the unemployment rate, yes, the unemployment rate, to go up. They want more people unemployed, so not so many people keep spending and buying up the goods and services. We see on the screen that the unemployment, the initial jobless claims, meaning the people that filed for the first time, the previous reading was 206,000. They expected that to go up to 215,000. Actually went down to 205,000. So the Federal Reserve really doesn't like that, but I think they're missing the boat on that as well. But let me go into some of the context of this. So here's where the Federal Reserve, this is basically where the CPI numbers are coming from. Okay, this again, the CPI is the inflation numbers. What I want to show you right here is this, okay? Down through here, we're going to start seeing energy. You're starting to see really collapse. Okay, we're seeing that through here. Look at just this. Fuel oil, it's down 16% in just this time frame. Let's go over to this. I want to show you the full context of it. So this is actually by the Fed, U.S. Bureau of Labor Statistics. We go down through here, and let's look at where the numbers are. So this is the final numbers for the year. You start going down through here. You can see where food is starting to come down. You're seeing energy across the board just plummeting. We were in June, we were up 7% for the month. Now this month, we're down 4%. You can see there's a lot of reversals in a lot of these areas with energy. That's why that's so volatile. We're starting seeing components of this as well really starting to take a toll. So if we go over to things like natural gas, here's what natural gas prices were. We actually expected, or I expected, natural gas prices to spike in December, January, February because of the Russian situation and everything else. Look where natural gas prices were. They were up here, look, what is this? 968 right through here. Where are they now? 390. Okay, so we're 2/3 off. We're about 66% lower than where we were. So that's a good, nice trajectory down. That's going to bring down inflation. Next thing you want to see is right through here, what's going on with crude oil. Crude oil year over year. Let's just go over the last 6 months. Here's where we were just 6 months ago. Oil was $100 a barrel. Now it's 78. So 20% haircut there. The next thing we want to see is used car prices. Used car prices are down 14.9% in 2022. So now here's where we really want to dissect this, okay? They go down through here and they say used car prices right here. They have it down 8.8%, okay? So between the time they did this study and basically today, we're seeing those prices really coming down. So that, in addition, is going to continue to bring down the inflation numbers. Last but not least, Here's where the rent numbers are. You can see right here, month over month, they're seeing rents down 1.4%. They have a year-over-year adjustment to rents at 4.8%. I want you to focus in on this because here's where the conundrum is. When we go over to here, where the inflation numbers is, they have shelter being up 0.8% in December alone for a year adjustment of 7.5. So you're thinking this, well, if they're showing it up, which this number has actually been down the last 4 months, that's how much these numbers are lagging. So if they were to correct their numbers, the Federal Reserve, if they were to correct these numbers to the negatives and where these numbers should be, we should be about a 5% inflation rate right now. It's still not the 2% that they're wanting, but it's a far cry from where we are today. So with all this good news coming in, here's exactly what's going on with mortgage rates. So what we follow on my channel is what's going on with mortgage-backed securities. It's a bond that trades on Wall Street. That's yield on the bond is the biggest component for your mortgage rate. So what I'm explaining to you is, or what you're seeing on your screen is the price of the bond. So let me explain to you how this works. Okay, so you're seeing the price of the bond right here. How this works is if the price of the bond goes up, okay, what you're seeing on your screen, that means mortgage rates or yields are coming down. Okay, so we love when this number is up. We don't like when it's down because when it's down, yields go up. Okay, that's the easiest way I can explain it. The bigger the plus number, the bigger the negative number, the bigger adjustment to mortgage rates there is. But some good news that we have on top of this is you can see right here, the MBS market is way up at plus 39. So what we're starting to see right here is look where mortgage rates are. We're now almost teetering back into the fives again, which I expected. I'm expecting this month we peak at we tip back into the 5 range. If you closed out there in the last few months in the 7% range, you might want to look to refinance that right now. But what I really want you to focus in on is this cell right here. I just want to focus in on the 30-year cell. Now, these are not my rates. These are no individual bank's rates. These are the national average, published by Mortgage News Daily on a daily basis. I have the link down below for you guys to subscribe to this as well. And you can go directly here. They don't sell your data or anything. You can even subscribe to my newsletter down there as well. And you find this information and much, much more. But what I want you to show on here is look at, if you can zoom in on here, you can see where the 30-year fixed was. This was in November. We hit a high of 7.375. Okay. Where are we today? Teetering at 6.125. So we're 1.25% off of the highs we saw just 60 days ago. So it is a nice pattern right now for mortgage rates. And we're starting to see house prices starting to ease as well, maybe giving you guys a nice little spring to jump into the housing market. So that's my report for today. If you'd like to learn more about me, what I do, what my team does, and how we might be able to help you, visit us. All you need to do is go to therateupdate.com. Here's our information. We need to help. Thanks for watching. God bless. Have a fantastic day. See you next time.